Hello, everybody. Luke Gromen, FFTT. Hope everybody had a great weekend. First day of spring coming, so it's nice that it's finally here. Hopefully, that'll be the end of the snow for us. So, with that, I'm going to jump right in. First question is from Todd. Seems like the base question is what instrument, asset / foreign currency will surplus nations hold their trade surpluses in? The yuan is not convertible. Crypto is very volatile. I think the system that is evolving rapidly now, or more rapidly now, but it's been evolving for much of the last decade since the great financial crisis, is I think you're going to increasingly see nations trade with each other in their local currencies. I think they will net out imports and exports of goods and services. And then if there's any net left over, some will probably be held in local government bonds of the deficit running nation. But I think some of it will be held in gold as well that floats in all currencies. And gold will be the neutral reserve asset. I think it's interesting in this conversation that even though yuan's not convertible, Chinese government bonds have outperformed treasuries on a 2-year, a 3-year, and a 10-year basis, which I learned in the last several weeks and really surprised me when I learned it. But gold has also outperformed treasuries on a 2-year, 3-year, and then a 9-year basis. Basically, if you strip out the 1/4 sell-off in gold in 2Q13, gold has significantly outperformed treasuries over the last 10 years as well, which I think is interesting to do because a big part of the recent gold fell sharply in 2Q13 as there was an unprecedented run on physical gold in the London and US markets. So I think the system is already moving in this direction. We can see central banks reserving way more gold than treasuries over the last 8 years. And I think it's only going to accelerate after the weaponization of central bank FX reserves that we saw 3 weeks ago when the US and Europe froze Russians' FX reserves. From Charles, do you think it would be better to hold more gold than silver in the months and years ahead? How do you see the price of silver reacting to the scenario you laid out on Grant Williams' podcast last week? I've always held more gold than silver. I actually sold most of my silver back in April of 2011 with above $40, which was one of the best sales of my careers, actually. Better lucky than good sometimes. But to answer your question, in my opinion, yes, I do think it would be better to hold more gold than silver. And the reasoning here is pretty intuitive, but I think once you're here to be straightforward. Number one, gold is on central bank balance sheets, silver's not. And you can revalue gold higher. Gold can be allowed to move much higher to be big enough to be used as a neutral settlement asset because for the very reason that it's not used for anything. Silver has the drawback actually of being used for something in this case. So I'll use a much more extreme example just to make my point. Let's say instead of gold that central banks decided to create a wheat dollar, right? Or a wheat as your neutral reserve asset, right? So we're gonna bid up the price of wheat to basically recollateralize the system, offset the debt on a net basis, be big enough to settle global trade in wheat. Okay, the price of wheat that we would have to see for wheat to be big enough to serve as a global neutral reserve asset would be so high that billions of people across the emerging markets would starve to death. And so you can see very quickly with this extreme example why using a neutral asset, a commodity that is used for something, is a really bad idea for a reserve asset. So silver, half of it's monetary, roughly half of it's productive use. It's an industrial good. If you used silver and if you bid the price of silver up as much as you needed to be big enough to settle global trade in silver, you would be pricing a lot of silver applications, industrial applications, right out of the market. You'd be making solar panels too expensive. You'd be making all the different applications way too expensive. And so that's kind of counterproductive to what a lot of policies we were trying to move toward. And so now, do I think silver will move higher in the scenario that Grant and I talked about? Yes, absolutely. I think it is going to participate in with inflation and probably at a premium given its criticality in a number of different important industrial and green energy applications. However, I think there's been over the last 10, 20 years, this growth in the gold to silver ratio. It moves around, but ultimately, I think on a secular basis, the gold to silver ratio will probably keep moving higher because, like I said, secularly, I don't know about in the short run, but secularly, um, because gold's not used for anything. The fact that, if you bid, if gold is made big enough to be the neutral reserve asset, unlike wheat, unlike silver, nobody's going to starve. No industrial applications are really going to get shut down because gold isn't used for anything. So I think that's why, for me, in the current scenario, in the scenario that Grant and I talked about, I think for me, I would rather hold gold than silver. I think you want to own both, but I hold more gold than silver for that reason. From Mike, in a recent interview and many in the past, you discussed the opportunity for the U.S. to revalue gold. When you explained it recently, it seemed like all roses. Aren't there losers for every winner in a restructuring? Who would be the losers? Those holding dollars? In a word, yes. More specifically, those holding dollar-denominated debt. Because inflation would likely surge in the revaluing gold, delevering the system, juicing economic growth scenario that I've laid out. Most bondholders, though, I think are still in denial that sovereign debt is so high globally as a result of kicking the problems upstairs for 25 years that their choice now is not make money in bonds or not make money in bonds. Their choice is now lose money in bonds via inflation or lose money in bonds via restructuring or defaults. That's it. That's where we are in the long debt cycle. And you get to sovereign debt bubbles. That's how these things work out. And so it's just, we haven't had a global sovereign debt bubble in 100 years. They're, in my opinion, very likely to lose money on a real basis. But look, bondholders had a 40-year bull market. It was a good run. But I think for me, I think that bull run's over. And I think ultimately, when we look back in history, the death of the 40-year bull market will be officially dated probably right after COVID, but it might, they might put the official date 3 weeks ago, February 26, 2022, when the US and EU weaponized Russian central bank FX reserves, basically said these FX reserves in extremis are not money good. Let's see, from Frank, housing is nuts, rates up, prices way up, bidding wars, all contingencies waived, no supply. Is this a blow off top, or is this the beginning of what happens during an inflationary cycle? To me, I think there's something, I think it's a part of an inflationary cycle, but I think there's something pretty unique to US history in particular, which is there are an estimated $35 trillion in assets, in wealth that the baby boomers hold collectively. They've spent the last 2 years being told by everybody in the media that they're going to die way sooner than they expected from COVID. And so now we're sort of unfolding from that, unwinding from that. And the boomers are long a bunch of money in their short time, in their minds and de facto, right? When you're older, you're short time. So I think when you do that, you factor in that calculus, they say, look, so what if the home price is up 20%? Buy it. So what if it's up 40%? Buy it. So what if it's up 50%? You know what? I've got this money, my kids, I want to help them. Buy it. When you add in required minimum distributions, when you add in Wall Street investors that have been bidding prices, all cash, increasingly aggressively over the last 18 to 24 months, I think housing is likely to be nuts for quite some time, and probably to a certain extent, not nearly as sensitive to rates as a lot of people think they might be. Because I think what we're really seeing when I say they have 35 trillion in assets, they're long money in their short time, 35 trillion in assets really represents the sterilization of inflation, of deficits that should have happened over the last 40 years. But instead, policymakers incented the baby boom generation to defer compensation, basically take some of those dollars out of the system, sterilize the inflation. Had they spent that money in the economy, you would have had CPI inflation at the time. Instead, it was sterilized in asset price inflation. Asset prices rose. But now, by virtue of their life cycle, it's coming back out of the sterilized asset inflation into the real economy. And I think housing is just a symptom of that. I think we're going to see more of it because there's really no interest rate that you can send rates to that the boomers are going to care, right? I mean, you're 70, 75 years old. You don't care if the rate is 4 or 8 on your house. You just want to own the house, buy the house, pay cash. It doesn't matter. Pay mostly cash, doesn't matter. I don't know how many years left. I want to own the property. I want to own the asset. I think that's no small part of what we're watching go on in housing. And I think it's going to continue. Ironically, the party that cares a lot about whether it's 4% or 8% is the US government. And they're not going to they can't afford 8%. And so at some point they will cap it at whatever rate they're going to cap rates at, the Fed will, and that will only add to the inflationary fire. So a little bit of a longer explanation, but I think it's important. From Ken, do you think there is an opportunity to trade bonds in the short term as rates could drop as the long bond sniffs out a recession, or is inflation taking over immediately, thus rates rise? Are you buying commodity funds, i.e. wheat, DBA, et cetera, or company stocks related to commodities? You might be able to trade bonds, buy bonds here for a quick reversal, but to me, that's a picking up nickels in front of a steamroller trade, as the old saw says on Wall Street. And I don't like doing those for myself. I don't like recommending those kind of trades for my clients because, well, it's a steamroller. If you're wrong, you get run over. In my opinion, it's not just the inflation. I think there's a greater number of people now doing the math, but I think the bond bulls, they're not doing the math. If you have a recession, you're going to likely have a default on either treasuries or on US entitlements, or they're going to have to slash defense spending unless the Fed prints the difference. And in my opinion, none of those things are going to get slashed. The Fed's going to have to print the difference. So the closer we get to a recession, the more likely we are going to see the need for the Fed to print the difference. And that's what I think you're starting to see, this recognition of bonds are now, after 40 years of riskless return, they're now returnless risk. Like I said before, either you're going to have restructuring issues in the bond market or you're going to have inflation issues. And that's what happens on the other side of a 40-year trade one way. When it goes the other way, I think secularly, you're getting into a stage of the cycle, the long cycle, where bonds are effectively returnless risk. In terms of what do I own, I mostly own gold, silver. I do own some copper stocks, producers, in terms of the commodities. And so that's the extent of my focus of exposure. So yeah, I said, could yields fall for a little bit in front of a recession? I guess it's interesting, as we see a little bit of a slowdown, that they're not falling, they're rising at the end of QT, which is a little different than what we've seen in prior ends of QE. Prior ends of QE we've usually seen rates fall, they're rising, which is a little different. It's a really tough trade to time though. And that's why for me, I'd rather own assets where you sort of win either way, where if you have a sovereign restructuring wave because of a recession in the West, gold's going to win. If you have higher inflation because central banks won't let sovereigns get to the point where they have to restructure a default, gold wins. And those are the situations where, it's basically gold is where bonds were for the last 40 years, except we're very early in the game with gold, in my opinion. And I think Bitcoin as well. Bitcoin's still trading a lot with tech, but I think ultimately Bitcoin's going to trade like digital gold, not like a tech proxy. From Andrew, in this week's third tree ring, you referenced the only politically palatable option as being the Fed suspends SLR requirements so banks can effectively buy infinite treasuries with no capital charge. Can you elaborate on no capital charge? So SLR is supplementary leverage ratio. It's under, I believe, Basel III regulations for banks. But in April 2020, the Fed suspended SLR rules, which mandate that the banks have to hold a certain amount of capital against every asset that they have. And that included treasuries. So if a bank buys a treasury bond, they would have to set capital against it. In April 2020, they suspended for a year the SLR regulations against treasuries specifically. And I think it's actually calculated. Treasuries count for so much versus riskier assets, right? So it's effectively the capital charge. It's effectively a capital charge against treasuries. That capital charge was suspended from April 20 through the end of March 2021. What that meant was effectively from April 20 through March 2021, banks could buy treasuries with basically no capital against it. It's basically infinite leverage. So they just buy the treasury, put it on the balance sheet. It does not account against the score that they used to calculate the SLR, which then implied a certain amount of capital. So it's basically being able to buy treasuries with no capital against it. It is basically Fed QE done by the US commercial banks. And so That's what I mean. It's really about having the Fed regulate the banks into a position where the banks help the Fed monetize U.S. government deficits. Banks end up okay with it too because they're basically no capital and they're collecting whatever coupon on the Treasury. So hopefully that clarifies what I meant by that. From Luke, if the Fed largely finances Treasuries with SLR exemptions, commercial bank QE, how will this impact the dollar and inflation as well as other markets? Will it be perceived differently than outright QE? I think many pundits and analysts will say, yes, this is different. This is not QE. I think the market will see right through it. I think the market will say this is just effectively more QE, call it whatever you want. It's liquidity. I think it'll be negative for the dollar, and I think it will add fire to the inflation. And I think some version of that is likely what's coming, but I think the market's going to see right through it. And in terms of things I would watch for to see I would probably look to what I think is the most sensitive liquidity metric out there, which is Bitcoin. I think if you start seeing Bitcoin start to rip higher, that may be a sign that people are starting to buy it ahead of expectations of some sort of SLR exemption, et cetera. SLR exemption for treasuries, excuse me. And then finally, Charles, how long do you give the US dollar to remain as the world's primary reserve currency? Months, years, or decades? I give it decades. I think what we're watching happen in real time is the US Treasury bond losing its status as the primary reserve asset. And I think it's losing it to gold. It has been in slow motion. I think it's going to accelerate from here going forward. Bitcoin could also serve that role if a lot goes right. But right now, gold sits on central bank balance sheets. Bitcoin doesn't. So let's watch and see. But really what we're talking about here is a modified version of Bretton Woods. It's really would be the Keynes proposal at Bretton Woods to have a neutral reserve asset like a Bancor, gold floating, gold serving as that role, basically gold floating in all currency terms, settling deficits. And I think it's important that gold was in the system from 1946 to 1971, and the dollar was the global reserve currency. So it's more, I think, the ending or the restructuring of this post-71 system where the dollar is the reserve currency and the treasury is the primary reserve asset globally. I think that primary reserve asset it has been being switched. It's accelerating, I think, from here. I think acceleration began on February 26th when the US and Europe sanctioned Russian central bank reserves, basically saying that FX reserves are not money good in extremis. And so I think that's going to move that toward gold, toward a neutral reserve asset over time. We talked about why gold makes the most sense. It's on their balance sheet. It's not used for anything. Nobody's going to starve if we inflate gold a lot, as opposed to wheat, copper, oil, etc. Silver, more productive commodities. Not to say they won't benefit from this, but I think gold rises more than everything in that scenario. So with that, I'm going to finish up. And again, thank you as always for joining me on this conversation. If you'd like to learn more about what we're up to or learn more about our Tree Rings product, 10 most interesting things, bit of a synopsis, ties in how it might be fitting with the way we're thinking about things or how it might be contradicting the way we're thinking of things. We just try to keep an open mind. At any rate, FFTT-LLC.com to learn more about it. Otherwise, everybody have a great rest of your week, and we will talk to you soon. Take care, everybody.